Hey, Joe.
Hey,
Welcome
how's
to
it
the
going?
show. It's been freaking years since I got to see you.
Yeah, it has been a while. That I've come down that one time when I came down and saw you guys down there.
Right.
I don't know if you remember or not, but I was pretty sick, and
Yes, you were.
I didn't realize how sick I was, and I feel really bad about it. I mean, this is years ago now, right? But I think it was like either later that day or the next day. I finally went to the doctor's office, and I actually had influenza B. I was
Oh
like,
my
oh,
goodness.
I was like sitting there thinking, like, I probably shouldn't have gone out. I felt
Well,
really bad about that whole
nobody
thing.
got sick. We were all good. So I'm
Yeah.
glad that you came out. So, welcome to the show. I want everybody to meet Joe because he's a freaking rock star when it comes to divorce and finance stuff because he is a certified divorce financial analyst. And that just kicks that whole stuff up enough. So, Joe, what's the difference between what you do and the other financial peoples?
Yeah, so we just really kind of specialize in kind of the thing I always talk about is we talk about like the art of divorce financial planning. Um,
Mm-hmm.
and because there's a lot of financial planners, there's a lot of tax people, and ultimately divorce does have a lot to do with divorce and finance.
Uh-huh.
But unless you're actively dealing with divorce on a regular basis, most professionals have no idea how to actually deal with it. Short of maybe like the family law attorney, but and we work with a lot of family law attorneys, and we love the attorneys we work with. But most of the attorneys we work with are not finance people; they're not tax people, and quite often they run into a lot of tax and financial questions, and they're not really sure exactly how to deal with that stuff. And so that's where we come in because we specialize in that and just in how to actually craft like really good settlement agreements that create equitable divisions for both parties. So it's a very unique thing because divorce is a very unique thing, and so that's kind of how we approach it. So
Where were you when I was getting divorced, dude? I mean, you know my story on the whole word exactly and the whole division of retirement and how I got screwed with the word exactly. You know,
right.
that if someone had taken a look at my decree and said, "Hey, honey, you're not protected because they took out these words of, Aleph will get X amount plus or minus the interest gains and losses of the market value," and that was deleted and the word exactly was put in. So I ended up
Um,
losing. Yeah, it was a deliberate thing, and I ended up losing um, like $5,000 of the interest that my portion had gained from when we signed the decree to when I went to Quidro.
uh,
And then
yeah.
my lawyer went and did it and did the Quidro and did the appropriate verbiage, plus or minus. So TIAA is like, oh, okay, so we're going to disburse, that extra $5,000.
Oh, that's good.
And I got the extra 5,000. I'm like, oh my God, this is lovely. And then
Yeah.
a week later, I got taken to court for defraud because
Oh,
I wasn't entitled to it because I signed a document that said exactly,
yeah.
you know.
Yeah. Yeah. And that's tough. And we want to try to avoid those issues. And when we talk to a new client or we talk to people that are going through this process, quite often people will rely on their friends and family, other people that have gone through divorce, and they'll say, "Well, in my divorce, this is what worked for me, and so you should do that too, right?"
Right, right.
And I think from a tax and financial perspective, I mean, we don't deal with any of the child custody issues. That's not our realm. But like on
Uh-huh.
a tax and divorce side, I think that's just really, really bad advice because the thing that I've seen is that every single person we've worked with, their divorce is so unbelievably unique to them.
Uh-huh.
What worked for us, for my partner and I, to work with one client is 100% wrong for another client, and it's literally like starting over every single time. And so it is really challenging to look at those divorce decrees and saying, okay, what's the best way to make sure that the attorneys craft these things so that the language is concise enough that both parties are protected and they're going to get what they need, but they're also pliable enough that as life goes on and things change, so like in your
Right.
case, that it doesn't create issues for someone to file an order to show cause and tell you that you're stole money that wasn't yours and so forth. And so it's just where the reality is, when you look at like Woodward divisions and how retirement is divided, the way that you did it was correct. But you're right. Yeah, if you sign up on that stipulation,
Right.
yeah,
I mean, I
it
signed
causes
the
problems.
document and the judge was like, sorry, honey, you signed a document that said exactly, and then
Right.
turned to my ex's lawyer and said, you knew better, don't do that again. You know what I mean? But like, what do you do at that point?
Right.
There's nothing, you know? So
Right.
like, honestly, that incident was one of my main impetus for getting Divorcee Cafe off the ground, because people don't know what they don't know. And they don't know that they can go to a financial advisor or someone to be like, hey, can you take a look at this section to see if it reads right? Or, hey, how do I create a budget and know what I need to do? Because everybody's a cuckoo head at that point and they just want to be done, that they don't
Right.
want to spend that extra time to kind of go and talk to someone about someone with finances. Like, oh my God, I just can't even deal with a lawyer and I got to add another financial person. But they're not thinking 5, 10, 15 years down the road of how that decision or indecision is going to affect them and their children. Do you know what I mean?
Yep.
So tell me what you got here. You've got this cool little PowerPoint thing and you're going to walk us through all of these things today. Tell me what this is.
Yeah, there's a lot here. So I mean, yeah, when you're ready, if you want, I can kind of delve into it.
Dive in. Let's go.
Okay. Yeah. So my partner Aaron and I. So I'll go through this a little bit, but so my background. I think I've got the stuff in here. So let me kind of dig into it. So my partner and I, Aaron, his name's Aaron Schuler. We run a company called Financial Independent Transitions. We just call it Fit Divorce Planning. We're both certified divorce financial analysts, and we do have financial backgrounds. Mine's a little bit different, and I'm going to go through this kind of quick so you don't have to read all of these things. But I've been in business for about 16 years, and my background is financial planning, asset management. We run a financial planning firm that's separate from this. But over the years, we were seeing just so many errors on the divorce side with our clients that we thought that it would be really good for us to kind of really focus in on work with clients that are going through this process. Mm-hmm. Primarily, we kind of focused in on working with a lot of divorced women originally. Mm-hmm. And I went through our case list about 2 or 3 months ago, and we've actually, it's interesting, we're actually representing men and women. It's almost 50-50.
Nice.
And I thought it was mostly women, but it is kind of 50-50. Some of just additional things on my background. So I'm also an enrolled agent. It's the highest designation given by the Department of Treasury. It's a little bit different designation than a CPA, where CPAs are regulated on a state level. Mine's federal. And the example I give everybody is that the education level for a CPA, it's like a lake that's an inch deep, but it's a mile wide. They have to know a ton of stuff about everything, kind of like attorneys, right?
Right.
The EA designation is like a lake that's flipped on its side. It's an inch wide, but it's a mile deep, and it's just federal. But we can represent clients before the IRS in all 50 states. And so the tax side of what we do really melds really well with the divorce stuff that we do, because there's just a lot that kind of crosses over. And then that just kind of goes over some of our other backgrounds. My partner, Aaron Schuler, our business is a little goofy. So I'm up in Weber County, Aaron's in Heber, and we also have an office in Rock Springs.
Oh,
so
wow.
We're kind of spread out like that a little bit. But it's worked really well in the COVID world because we do a lot of remote work now. So it's been pretty good. These are the other companies that we run besides, the financial independent transitions. Like I said, we run a tax office and a financial planning office as well too. So the thing that, going back what you were saying, is that most financial planners are not divorce experts.
Right.
There's a lot of
way.
Yeah, there's a lot of tax people and there's a lot of financial planning people that think that they would be, but unless you've gone through your own divorce, and even if you have, it's just a really unique thing. And the other thing that we look at is most financial planners can't give tax advice, and so all those types of things. And so that's where we have that crossover between the financial planning and the tax advice, so we can really work well with our clients and the attorneys that they work with. So a lot of people ask, what is a CDFA? This is just a real basic thing. CDFAs, we focus in and specialize in financial planning. And so you can actually go to the Institute for Divorce Financial Analysts, the national organization, and you can search up CDFAs in the area and find somebody who's, close, that type of thing. The biggest thing we tell everybody is that while my mom, when I was a kid, she told me I should become an attorney, and maybe I should have done that. We do work with a lot of attorneys, but I'm not an attorney, so we don't give legal advice. And to be honest, with all the attorneys I've worked with, and I see some of the stuff they have to deal with, I think I'm
you don't want to deal with that, dude.
The enrolled agent, right, as I said, it gives us unlimited rights to represent taxpayers for the IRS. The only people that can represent clients, so I can sign tax returns, I can do that type of thing, are attorneys, CPAs, enrolled agents. So a high level of fiduciary standard there. What I'm going to do is just kind of go through like the divorce process as we see it, and this is going to be a 30,000-foot overview, and then we'll go over like the 3 major issues that we run into on a regular basis, and then
because we have tons of time over the next few weeks and months, and we can pick all these things apart. So if people want to find out more information, we can totally do more sessions here. Go ahead.
And then one thing I can do too. So like one of the things that we do, well, and I'll show some stuff on this later, but everyone we talk to, and we give we'll give them free access to a program called Family Law Software. And I can give you access to it as well too. And so somebody who's going through this type of thing, if they want like a good electronic location to like store all their budget and finance and assets and be able to get that stuff organized to prepare for their own divorce. So if they're pro se, or even if they have representation, they kind of get that stuff organized for their attorney. I'll make sure that you've got access to it so you can see that as well, because that's how we help all of our clients. So just basic things that we see. So when we're looking here, so talking specific to Utah, because everything here is Utah, whether somebody's, so this is going off if somebody's, pro se, so they don't have attorneys, so they can complete their documents through the online court assistant program, which we just lovingly call OCAP. Petitioner's got to file and serve. They got 120 days to get that done. Respondent's got 21 days unless they live outside of the state. And then they can file that stipulation. And, divorce does not have to be horrible. It doesn't have to be this really contentious issue, although it's very rare. When we work with clients, we're either hired as an advocate for one party, as an independent neutral by the attorney, to come in and just review the stipulation, that type of thing. Or sometimes we are hired as an expert witness and then I'll testify in trial if it comes to that. But every so often we'll work with really, really amicable divorces. My partner Aaron and I we're just finishing up a case right now. This couple went to mediation a couple weeks ago. They're after meeting with us a couple times and getting everything put together. Their mediation was 17 minutes long.
Wow.
Okay.
So much better than my 5 hours. Holy hell.
Yeah. So they did have to pay us, of course, but this was a really amicable couple that looked at this and said, okay, what's the most logical way to do this? So they brought us in as an independent third party where we weren't, representing either one of them. And we were just really forthright and honest with both parties as far as this is what you get, this is what you get, this is what's going to happen. And then we wrote a report that gave them 3 options to consider. And they took that, they talked with themselves, took it to mediation and made a decision.
Oh, that's perfect.
So those are kind of like those perfect cases, I think. But they're few and far between.
Dude, I know.
So for the rest of this, just basic rules of procedure for the state of Utah. We pulled this up off of the Utah Courts website. If you've never seen this before, have you ever seen this?
No, what is that?
So it's a roadmap. It's available on the Utah Courts website. And it just walks through, like, what does the divorce process look like? How does this work? Right?
Oh, that's so cool.
Yeah. And it's, and so you start up here. So you have like the case starts, right? So we got to prepare the files. Then again, they have that 120-day period, right? And if we start with the parties agree, if the parties agree, they file that stipulation. They've got a 30-day waiting period, right? And if there's kids, they've got to deal with the child education class,
right?
And they file, and those final documents are filed. The judge reviews and the decree's done, right? Like it can be that simple.
Wow.
If the respondent doesn't file an answer, right, then it could be a default judgment. And again, I'm not an attorney, but I have worked on cases where there were default judgments. And I haven't seen one go through yet.
Oh wow!
But it could happen theoretically, right? But usually when somebody starts seeing like their wages getting garnished for like really high amounts of child support, they pay attention pretty fast.
Exactly.
Now, if they disagree, it's going to be contested, and Utah states that if it's a contested divorce, that mediation is mandatory. Parties file their declarations, their income, and their disclosures. Ideally, there's a timeline on when that should be filed before mediation. I've had mediations where the opposing counsels provided those documents to us the night before.
Oh my God.
Or they haven't even done it, and we've gone to mediation not even knowing where we're at, right?
Oh my
And so
goodness.
we've dealt with that. But it is what it is, and so parties can agree. They can file a stipulation and agree up until mediation, and then they go to mediation. If it works, then we kind of go through this whole process again. They file a stipulation, go here, and then if it doesn't work, then they're going to have to go down that trial route. And as I'm sure you already know, trial is just so rare.
It was so funny when I got taken to court, and I was sitting there with my lawyer, and and his lawyer was standing up there, and he's talking about this person. I remember tugging on my lawyer's shirt and going, wow, that person that he's talking about is really horrible. And she's like, oh, he's talking about you. And I'm like, are you serious? You're talking about me? Like, I was just like, am I really that bad?
Right.
You know what I mean? I was so like flabbergasted. I'm like, I was so confused, but because 7 days I had $5,000, and then I'm taken to court for defraud and lying, and I'm like, but I didn't even know. you know?
Yeah, it can be pretty rough, and we've had clients have those similar kind of experiences. The opposing counsel will get up there, and they can say some pretty gnarly things sometimes. A lot of our clients in a contested divorce, they don't go down that full trial route. However, like going back on this roadmap, we see that motion for temporary orders. We see that quite often. So if we have stay-at-home moms, that type of thing.
How do you get the temporary orders like enforced? Because I had asked my lawyer to get temporary orders enforced, and she's just like, she didn't do it. And then his lawyer said he would, but I went 8 months with no money whatsoever, like nothing. No, I couldn't get anybody to write temporary orders. I filed in November, and I did not get any money, child support or alimony, until the following August. So how do you even get somebody to do that? I mean, that just was crazy to just get any sort of finances, Yeah,
it is challenging. And we've had cases where they feel like the commissioners that they're going to go in front of aren't really friendly regarding that. And so they'll kind of drag their feet. And there's, we see a lot of issues surrounding getting those things actually put in place. But coming back, we'll kind of come back to it, but the financial declaration, it's really important that those are taken care of properly. And really, I mean, it's basically two things. It's going to be your income and your assets, right? And so having a really good detailed budget that's logical, that makes sense, that, and that can be the way those financial declarations look today. You'll have one column for all of your current marital expenses, and then you have another column for all your post-marital expenses. And so somebody who's going through temporary orders, we'll take that information, or we'll help them put that together so that it can get in front of the attorney, and so that they can make a good argument as far as why they're going to request, how much spousal support they're going to need, and be able to get the proper amounts of child support and all that. So, the timing of it definitely is. I'd love to say, people don't. Ideally, they shouldn't have to request the temporary orders, but those that do, we'd like to see them getting it sooner. But it does take some time, unfortunately. So. At its most basic level, when we look at divorce, we try to break it down and make it as simple as possible. And it really is three issues. It's child support, spousal maintenance, and property, right? And so these can get really complex, but we kind of like to deal with them in this order. It seems to make the most sense for us, but every case is different, like I said before. So just talking about child support, as I said earlier, when it comes into child custody and everything that surrounds children, it's really outside of our scope as far as what we deal with. And I really don't get involved on that, other than when the attorneys tell me, hey, this is going to be the custody guideline, how do we justify how much support? And then we'll come in and help determine what the actual income is. If we've got two people making W-2 wages, that's pretty easy, or just one person. But when we've got a business owner, it gets a lot more complex.
I can see that.
But it is not negotiable. The child support, I need to make this link better, but you've probably seen the calculator that's available on the Utah Courts website.
Right.
And so this one's generally going to be the easiest one to kind of deal with, because it is what it is. It's just the child custody guidelines that we'll see that coming through. But the issue that we see here is tax issues on who gets credits.
Right.
And when we're dealing with child tax credits, there's basically two that we tend to run into, or actually there could be three. But as far as the state's concerned, the state's going to be looking at children under the age of 18. After that, they're emancipated, and the state really doesn't want to see them, or they're not even going to talk about them in a divorce decree unless the couple stipulates to it, which is very, very rare.
Right.
But assuming this child's under the age of 18, when we're looking at tax credits, the custodial parent is generally going to be the one who's going to be able to claim that child tax credit from year to year, right?
Yeah, and that's the other thing, that if I had a financial person, then they would have been able to do that, or at least to give me some sort of support of going, hey, I am I have sole custody of my child and I should get tax credit. Where at the time I didn't know, and I was an emotional cuckoo head, and they wanted to basically, split it. So we alternate every other year.
And that's pretty common. So somebody who has sole custody, I don't know if I see that in fact, I don't see that, but but if there's joint legal physical custody.
Well, joint legal, I would totally understand, sole custody. I just had no idea of how that, again, when you're an emotional, point in your life, you don't even know what questions to ask. And I didn't know that I was entitled to just having the tax credit. I just wanted to be done. And if it was a negotiating factor for me to be like, all right, we'll alternate every other year and you get even and I get odd years, then let's just be done, But there's so many things that you just don't know, because you're just you don't have that financial person to back you up or to give you the sound advice that you need.
Yeah. And the tax credits, and the tax issues on the children, they can be simple, but they can get a little bit goofy depending on the cases that we're dealing with.
Right.
But bottom line is the custodial parent will get that tax credit unless there's a form through the IRS. It's called IRS Form 8332, and it's a release of tax credit to a non-custodial parent. So if your decree says, hey, we're going to split it, that custodial parent should be providing that form to them every year, or they could actually fill it out and say, okay, well, I'm going to give you this credit for all the years in advance or whatever. They can do that too. But they should provide that to that non-custodial parent, because as a non-custodial parent, if if that child didn't live with me for 6 months and I didn't provide for more than 50% of their support, I don't meet the IRS guidelines to get the tax credit. So that form allows me to get it, right?
So is that something that my ex would have to do? Because I mean, I don't talk to him. I don't know anything about that. But is that something, because he's a non-custodial parent?
Yeah. So if you're splitting that tax credit, you should be providing that form to him. He doesn't send it to the IRS. He would give it to his tax professional, who would then look at it and say, okay, I'll justify giving you this credit because this states that you can do that, right?
Okay.
But there's some credits that can't be split. So like when we're working with people that have young children in daycare, we have dependent care credits, right? Yeah. The dependent care credit cannot be split. The dependent care credit goes to the custodial parent no matter what, right? And so sometimes we'll see decrees that say, hey, we're going to pay we're each going to pay 50% of childcare, right? So daycare services and all that. And maybe it's like $1,000 a month, right? So we'll get a guy who's paying like $6,000 for daycare, and then he thinks he's going to get half that dependent care credit. And unfortunately, he can't. It'll only go to the custodial parent.
Well, that's good to know. Win for me.
Right. But again, but that's different than the child tax credit, right? So that one can rotate. And then we get into the issues. Well, what happens when we've got a contested case where both parties say, hey, I get to claim this child this year, right?
Right.
And maybe the decree is not very clear, or maybe we have one party that's not going to live up to the decree and it causes issues, right? So, so every once in a while we'll run into this. So like we have cases where we'll have whether it's a custodial or non-custodial parent, we'll have a parent who claims a child in a year that they're not supposed to. And then we'll have our client come in, we'll file their tax return, and the tax return gets rejected because this child was already claimed, right?
Right.
So if that happens, and we can justify trying to claim the credit for our client, then what we'll do is we'll have to file a paper return along with a copy of the decree and an explanation, and we send that into the IRS. We basically say, hey, so-and-so over here should not have claimed this child. We should claim this child, and here's all the reasons why. And then we put it into the hands of the IRS, and the IRS will more than likely send what's called a CP 2000 letter to the other parent and say, hey, you took this credit, you shouldn't have done it. And they'll pull that credit back.
Mm-hmm.
But in other cases where it's not clear
Uh-huh.
who should claim that child, especially these are cases when, again, these are kids over the age of 18 that are still dependents. You can, if they're still living at home, you're still providing for more than 50% of their care. If they're still
Mm-hmm.
living for more than 6 months out of the year, you get like an 18, 19-year-old, that type of thing, that's still in high school or something like that.
Mm-hmm.
Then we get into these issues where you've got a person who still has a tax credit of $500, so it's not a ton,
Right.
but it's still there, and we'll have both parents trying to get it. And the IRS is not going to stand in the way and say, hey, we're going to sit there and interpret this divorce decree. They're not going to do that.
No.
So what they're going to do is they're going to follow a tiebreaker rule, and they're going to look at it and they're going to say, okay, parent A, how much money did you make? And they'll say this. And they'll look at parent B, how much money did you make? And they'll say this. And they'll look at the two, and whoever made the more in the higher amount of income, that person will get the tax credit, right? So
the higher income would get the tax credit?
Yep.
Well, that kind of blows.
Well, unless you make more income, right? so
because usually it's the parent that has the lower income that would benefit from the credit.
Right. Right. But on the other hand, the person with the higher income will also benefit from the credit as well. And they also pay more tax, right? Yeah. And the IRS, and so when we have a couple that won't agree, the IRS will just look at it and they'll say, okay, who made the most income? And they'll use that as a tiebreaker, right? Which kind of stinks. So then if we have a case where they're going to contest it every single year, and if you do have one spouse who's making like $200,000 a year, and you have another spouse who's making like 40, the other person's obviously going to get the credit every single year. And unless they want to take that person back to court and try to modify the decree, it's going to be a problem. And so it's just one of those things, right? So tax credits can get kind of messy depending on where we're at. So spousal support. So most states, spousal support is not mandated by guidelines, and Utah, of course, follows that. It just basically says, hey, up to the length of the marriage. And Utah follows the Jones factor, and I'll get into that a little bit. But as you probably know this as well, the Tax Cuts and Jobs Act, so that TCJA, right? It used to be that this was reportable income for the recipient, tax deductible for the payer. No longer the case. So that is set to sunset in December of 2025. And so we'll see if Congress pushes that out, extends it, or what happens. I've had some clients say, hey, with the Democratic, presidency and Senate and Republican House, are they going to try and repeal the Tax Cuts and Jobs Act prior to that? Right. I don't know. I don't see them doing that, but it could happen. I mean, anything could happen. I kind of hope that they don't, to be honest, because if we see a client who's paying any amount in alimony, and they were in this little window where it's not deductible, right? And then they make it, tax deductible again, they're going to have a serious issue with that, right? Right. And so it's just kind of a mess. And so we'll kind of see where that goes, right? But that most heavily weighted factor is going to be need versus ability to pay. So Utah follows this Jones factor. It's based on a case, and it's that need versus ability. It's the need for the recipient to maintain their standard of living, right? Whether that standard of living is $3,000 a month or $30,000 a month, the court isn't going to say you're not entitled to that amount of money. Right. They're just going to look at maintaining that standard of living, and they're going to look at that person's need for spousal support versus their ability to pay. And then on the other hand, when they look at the payer, they're going to look at that person's need to maintain their own standard of living versus their ability to pay. And then we're going to find, the courts will often say, hey, we're just going to split the baby, and we're going to find a road that's going to be, manageable for both parties. So when it comes to spousal support, we spend a lot of time on this with people. So if it's a contested case, we'll get really detailed on the budget. And when we're talking to the payer, we're going to look at it and say, hey, when you go to mediation, we know that this amount is the maximum amount that you can absolutely afford. You can't afford anything more than that. Right. And so when we go through mediation, anything above that line is going to be a hard no. Anything below that, you could actually live with.
Right. No, I get it. I mean, live with it. We did a step down alimony. So I was married for 10 years, and so I was entitled to 10 years alimony, and I didn't want to be beholden to someone for 10 years. I didn't want to start off at like 44 and then, just be like, oh, I got to start my life over because now I don't have this money anymore. So we made the choice together to do like a step down plan where we started off high and then gradually reduced it every year, every 18 months to where it ended up going away after 5 years. You know, again, you know, I just want to keep stressing the fact that having someone who's financially, you know, aware of these things in your corner is very helpful, because in my experience, I felt like I was strong armed to kind of give up 1 year of my alimony. So we agreed to 5 years of alimony. And then I hadn't gotten any money for child support or temporary orders. And it was like, all right, well, we'll sign the decree, but we're going to backdate your alimony to January, which was 8 months before. So I just, at this point, I just wanted to be done. And I was so emotional about just being complete with it that I signed. So I signed away 9 months of any sort of money just to be done. If I had had someone in my financial corner be like, hey, this is how this whole thing needs to go, and this is the budget, and everybody can afford this, you know, and we're not going to kind of strong arm someone, you know, I might have felt more comfortable having someone who knew more about that to be like, no, we're not going to do that. We're not going to sign away 8 months of alimony and child support.
Right.
You know,
yeah, it's interesting, you know, something you keep bringing up, which makes a ton of sense. But I have a hard time relating with it. And it's just because I haven't been divorced myself, but the emotional issues that people deal with on divorce, right, are really high. And one thing we talk about in our financial planning practice is like, let's say somebody gets divorced and there's a big settlement, and all of a sudden they've got like $1 million in their bank account because there's a big settlement or something, right? And you're in this like really high emotional state. Going through divorce in a lot of ways is almost like dealing with the death of a spouse. And we always tell people, you know, money and finances don't mix. Whether you're feeling really greedy or you're feeling really fearful, you know, and when you're putting these situations where you're being forced to make like long-term financial choices, it's just a really bad combination.
It is.
And so when we started doing this work years ago, because again, I've been in business for about 16 years, and we started doing the divorce financial planning, really focusing in on it about 6 years ago. When I first started doing it, the first couple cases that I did, I approached them very similar to how I approach everything else we do in our practice. And to be honest, I got really emotionally involved with our clients in terms of like just trying to connect and empathize with them as far as what was going on. And it was so draining and exhausting.
It's very draining.
And we had a couple cases where there was one in particular where I came this close to just hanging it up. I'm like, you know what, this is a good experiment, but no, this is not for me.
Oh.
and happened to have a conversation with an attorney, a friend of mine, a good friend of mine. He's actually my attorney. And I said, hey, his name is Dan Craig, and I'll share his name, but Dan's a good attorney up here in the area, up in Weaver County. But I said, Dan, how do you deal with this stuff? Because he's doing family law forever.
Yeah.
I said, how do you deal with all this? And he looked at me and he's like, you just do. And that was the end of the conversation. And I thought, and my immediate response was like, man, that's really bad advice. And the more I started thinking about it, I was thinking about how you approach things, and the best attorneys that I know, they really do kind of like segment, you know, what their job is from all the emotional issues and the various things that are going on, so they can really focus on what they're doing. And to kind of bring that point home, my dad had a triple bypass last January, and he's doing fine now. But I think about like, you know, our role as far as what I do, or like what a really good attorney does, very similar to like the heart surgeon that helped my father.
Right.
As a family, this was a really highly emotional issue. My dad, up until he was told that he had coronary heart disease, he was told he was perfectly healthy.
Okay.
I mean, he's older, but he had no high blood pressure, no high cholesterol, no diabetes, he had nothing going on. He's just old, right? And then all of a sudden, he's got like horrific coronary heart disease because he's never had his heart checked because he's always been told he was healthy, right? And the surgeon did a phenomenal job, took care of my dad, and he got in, got out, did his thing, and it was just a job for him, right? And so when I think about like what we do, or like a really good attorney does, When we have a client that's going through this really high emotional state and they're dealing with money, they're dealing with finances, they're being forced to make this decision. To your point, it is really, really, really helpful to have somebody who's just kind of like cold and analytical on your side, who is completely separated from those emotional decisions and can look at this analytically and say, okay, what's going to work, what's not going to work, and we can take away that emotional issue. And it is a little bit weird for my partner Aaron and I. We had a mediation a few months ago where we got a really good settlement for our client, working in conjunction with her attorney, and she's signing her stipulation and she's crying. And to be honest, though, Aaron and I kind of felt like $1 million because we knew that this was going to work. We knew that she was going to be okay. And she was really upset, and I understand that, and we could sympathize with it. But we were able to kind of help her through that process. So then as she's gone through and we've reviewed it again and again since then, she's looked at this and said, oh yeah, that those were good choices. We did make good choices.
Because when you're in the middle of it, you just have this energy, this anxiety that's just like, how am I going to do this? And I just want all of the hard heaviness to just be done. And can I just sign and can it all just go away?
Right. And that's where mediation is really tough, because you do get to that point on mediations where it's like, if we're in it, it's like 10 o'clock at night and, people are just, they want to be done. And so they tend to want to just force things through, and so it is a balance. It is challenging for sure.
Well, at least people have resolution to the mediation. My ex and his lawyer got up and walked out.
Yeah, that happens.
$2,000 later, I'm like, did we solve anything?
Yeah.
I'm confused.
Yeah, it's challenging. So let me kind of go through this other part here. So on that divorce stuff, so we do a lot of post-divorce planning with people, but this is just kind of going through that amount there. So we're saying, do you know how much support your needs and for how long, kind of getting that figured out. We kind of touched on that as far as making sure what's going to work. We did have a case, I can't remember when it was. It was a couple of years ago. It was like a 23-year marriage, and she fought really hard to get 23 years of alimony, and she got it. But it's not common, for someone to get it for that length of time. And we'll see if she actually receives it for that period, but it's what it is. One question we'll have a lot of clients say is, do we want to have this decree modifiable or not? And so basically what we're saying is that spousal support, is that something that could be changed or be flexible depending on people's incomes and situations as they change? Again, that's a legal question. We can't answer that. The example I always tell people, though, is that whatever decision you make in your decree or whatever you stipulate to, especially something like this, if it's like modifiable, I always tell people the door swings both ways, because we've had cases where someone said, hey, we want to modify alimony and child support a year later, and the whole point was because the opposing counsel felt that our client's income was going to go up substantially. They wanted to kind of capitalize on that. And then we come back and we reassess everything a year later, and we find that not only did our client's income went up, but also so did the opposing counsel, their spouse, and those payments actually dropped, right? And so
well, it can go absolutely both ways. I mean, when you start modifying things, you have to be prepared, for your stuff to be included, and I think that's what people, especially maybe women who are trying to modify child support because they see their ex has gone in, and made more money. And it's just like, well, maybe the child support parameters have changed and now it's going to be lower. And you don't know that because you don't stay up and up on all of the different divorce, changes in the government and stuff like that.
And this is, again, kind of going back to that, especially with child support. Again, I'm not an attorney, but, we always refer people to their attorneys on that. But it's been more than 3 years since the date of entry. And if that opposing party's income has gone up, I think more than 30%, I think is the number, they can go back and file a petition to modify and do those types of things. And so you can do that, but we always just refer somebody back to an attorney on that. On the tax issues, again, we see this so much, and right now it's January, and so we're not too, we are concerned about it right now. So we have divorces that are going through, but when we're especially when we're dealing with a household where we have again that kind of discrepancy, we've got we typically, not always, but we usually have like the male husband who's the breadwinner. We've got the wife whose income is lower or non-existent because she's been a stay-at-home mom with multiple children. And we see these tax statuses and how they change. People kind of forget how the taxes work. And so the biggest thing we always talk to people is that post-divorce tax consideration. What's your filing status going to be? And
Right.
the IRS will look at your marital status on December 31st, and they're going to say, are you married or not? Right.
Mm-hmm.
And if you're not married, then you're either going to file single or head of household. Right.
Right.
And so if we're getting late into the end of the year and it's like, third, fourth quarter, and we're working with a man who is going to be paying alimony and child support, and he's going to be filing single, this divorce is going to go through by the end of the year. We always say this is really good advice to consider now, but they need to really consider what their tax withholding looks like through the entire year. Because if he was withholding as if he was married jointly the whole year,
Right.
and then he gets divorced, he's going to file single.
Uh-huh.
He's going to put himself in a real bad world of hurt when he goes to file the next year. He's going to owe a ton of taxes because his withholding was inappropriate the entire time. Right. So we're talking to people right now that are going through this. We're going to talk to them. Hey, what does that tax status look like? How are you withholding your taxes? And you should really be treating yourself as if you were single right now, so that you don't get slaughtered later on when you file next year.
And these are things that people don't think about.
No.
They just don't even have an idea.
No. And it's these little things that sneak up. It can be
Mm-hmm.
kind of hard, right? Insurance and support. We always see things in terms of like, what happens if a payer dies. And again, these are statutory things within Utah, but like as far as spousal support is concerned, like you can't go after a person's estate or anything like that to secure support. But quite often we will see, life insurance proceeds written into decrees in terms of protection for child support and, alimony amounts. So if you're entitled to alimony for say 9 or 10 years, and then, your ex passes away, you can get that remaining amount from his estate. And so we see that quite often. Back in 2019, there was an automatic injunction that was issued. It was Rule 109. And it basically said, hey, if you're under temporary orders, you can't, the person who's providing that health insurance and life insurance and all that, there's a bunch of things that were in there basically say you can't, be a horrible person to your future ex-spouse, but you also can't dump them from the health insurance plan prior to the divorce proceeding and those types of things. So it kind of protected that person. So there's good things that are there. One of the biggest things that we deal with quite often is, helping people determine what's marital and what's non-marital in terms of property and assets, and just understanding that not all of them are created equally. And so when we're starting to look at these different assets, the biggest thing we're saying, okay, marital is going to be anything that was accumulated during the marriage, that was given as a gift, right? And that's basically it. Separate property is going to be anything that came in prior to the marriage, that was held separately in your name, that was an inherited or a gift to you as well, right? So that's kind of what we look at there. And so where we get things a little bit more complicated is when we're dealing with, say, like you brought up the Quadro 401k plans.
Right.
We just dealt with a case recently where we had a 401k plan that's to be split, but there was like, I forget the exact number of years. The individual owned it for about 10 years prior to marriage, and he's held it throughout the length of the marriage. So there's both marital and non-marital assets inside of it. And so we'll come in, we'll trace that asset to determine how much of it's marital, how much of it's separate, because 401k plans are a little complex on determining how much of that is concerned, right? The other thing that we do a lot of is looking for hidden assets. I always kind of say divorce is almost like a crime of passion. And what I mean by that is like, it's like you watch like one of those whodunit shows, and it's like always the husband, right? Like it's like,
got money hidden in the keynote.
It's pretty easy, right? And so we get somebody who's got a lot of money, and they decide that they want to get divorced, and then they start trying to hide assets. It's really, really, really hard to do a good job of it unless you are a business owner that's operating 100% cash.
Okay.
That's the gist of it. So if we have a business owner that's operating almost 100% cash, that gets really challenging in terms of trying to find hidden assets. But outside of that, it sometimes it gets challenging, but we can kind of start going through and trace and do a lifestyle analysis to actually find out what's kind of going on there. But if we look at the most common hidden assets, cash is always going to be number one. Overlooked or undervalued assets. They'll say, "Oh, my husband's got this car, or he bought this gun," and it could be like a $20,000 gun, right? You just don't know. And if you don't know, you don't know. Business bank accounts, expenses, non-income producing real estate like raw land, things like that. and then just, a few different things in there. Every once in a while, we'll see assets being transferred or sold to a third party, or, we'll get somebody paying an employee like an exorbitant amount, that type of thing. So we can kind of start tracing it. And so sometimes it's not a matter of, can we actually find the money, but we can usually find transactions associated with it. Right. And that's where if we're getting into a really contested divorce and those types of things are going on, that's where the attorney's going to more likely have to subpoena that information and do depositions and try and find out what's going on with all that.
Naughty people.
Yeah, but the best way to find hidden assets, the number one thing we look at is financial declarations. We look at lifestyle versus what's going on. We had a case a while ago where a guy wrote that he was losing money every month, but they also drove $200,000 vehicles. She spent $5,000 a month on clothes, that type of thing. Wow. The financial declarations didn't match the lifestyle, right?
Right.
So that's like number one. And then if they are a business owner, we start looking at books and records. Because of my tax and accounting background, we will look at profit and loss, balance sheets. We'll go through all that information to see if there's anything that's going on there that's kind of a mess. Unfortunately, most business owners, especially small business owners, are really terrible with their bookkeeping. And so that's not necessarily the best place to go, but we will go through all the bank accounts. We'll start tracing that information. And then the best thing is tax records. So tax records, so that Form 2848. So I mentioned a couple times that I can represent clients before the IRS. So this is a great form. It gives me power of attorney and a POA. So we had a case a few years ago where we had a husband and wife getting divorced. Husband controlled absolutely everything. And she had no idea where anything was. No idea. She had no access to bank accounts. She had nothing, right? And she came into my office. She was pretty concerned. Because she was afraid she was going to be destitute because she had no access to anything. Right. And so I said, well, tell me about your taxes. And she said, oh yeah, I signed taxes. And I said, do you sign it with his name? And she said, yes. And I said, all right. And so we pulled all their tax transcripts and we found pretty much everything. And as much access as he didn't give her, he made her a joint owner on pretty much everything. Oh, wow. And we were able to pull a tremendous amount of information. And what allowed us to do is we found from the tax records, we found out who their CPA was. Once we found out who the CPA was, then we simply all it was just writing a letter to the CPA saying, hey, we need all the tax records regarding all these things. And because she signed off on everything, the CPA was legally obligated to provide her own tax records. Right. And once we had all the information, then we were able to start compiling all this information as far as really kind of formulating like what type of assets they owned, what type of things were going on there. And it really set a really strong foundation. And so tax records can be really, really good in terms of finding money, but simultaneously they can be really bad because tax records are horribly deceiving. There are legitimate tax practices that allow us to depreciate and to provide depletion and certain deductions, especially again to business owners that are completely legitimate. However, they can really tell a story that does not accurately reflect how much money this person's actually making or how many assets they actually own. But it gives us a foundation to kind of start from, right? Then we go through bank accounts, inventories, business valuations. Those are great ways to kind of find those assets, right? So separate property, like I mentioned before, these are assets brought into marriage, left in a separate name, inheritances and gifts. We had somebody I consulted with a few years ago, soon to be ex-wife, was inheriting about $500,000 or so, something like that from her dad. She smartly opened up a bank account in her own name, put that money in there. And he called me thinking, hey, my attorney said that this money's not mine. What do you think? And I said, yeah, unfortunately, it's not. Right. He was pretty unhappy about it, but it is what it is, right? Right. But we've had other cases where they commingled that money, right? Or somebody has a house and they refinance it and they put both their names on it, and that's when we can take separate property. It can be combined and it can now become marital. Most common issue again we see is like 401k accounts. We can see the premarital money being premarital, but then marital contributions going into that plan while they're married, right? And so that's kind of where we start seeing some differentiators there. That marital property, again, it's accumulated during the marriage, cash, real estate, businesses, 401ks, that type of thing, right? Are you familiar with the Woodward rule? Do you know that?
Dude, I am not a maths financial person. That's your shit, not mine.
So you talk to someone that's got a pension, right? Utah, so we call it a coverture fracture or calculate. But Utah follows the Woodward rule. It's based on a case, and you can, if you go to my website, there's a link to it, so you can kind of read it there. But it basically is just a very simple calculation to help determine how much of that pension is marital or non-marital, right? So those are pretty easy to kind of follow. When we get into the home, one of the questions we always see is people say, hey, should I keep it? Should we sell it? What should we do? Again, those are legal questions. So we can't tell you what you shouldn't do, but we show you what will happen, based on those decisions, right? The tax issues we see is, and this is still intact, is that if the home is to be sold, there's a tax exclusion of $250,000 per person or $500,000 if you're married filing jointly. Again, if the divorce happens, so we'll see cases where people say, hey, we're going to sell the house, and they'll sell it while they're still married. Right. And then they get divorced like a few months later. And sometimes we'll see people, they're smart enough to be, to kind of get themselves into trouble. Right. They'll think, okay, I've got a $500,000 marital exclusion here, so there's no taxes. And then they get divorced, but they do it in the same exact year. So when they file, they're actually going to file single, and now it's $250,000. So there could be taxation issues, right? In order to qualify for it, people have to live there for 2 out of the last 5 years. But there's really good, interesting sections of the tax code where it's like, say we've got one spouse who's going to stay in the home, and the ex-husband's going to keep paying the mortgage as part of his support payment to her because they want the kids to stay in the home while they until they graduate high school or something like that, right? So husband moves out, they get divorced. She still lives in the home, and now let's say the home is now hers and he's paying the home. Let's say they stipulate that when their youngest child gets out of high school, that they're going to sell the home and then split the proceeds, right? The interesting thing about the tax law is that it's the non-spouse who's not there anymore, even though he or she hasn't lived in the home for the last several years, they can still use the exclusion from their marriage for the previous spouse who still is in the home. Right. So the capital gains exclusion ratio is really good. Even with real estate skyrocketing like it has here in the area, we still don't see this being a problem for a lot of clients. It's pretty rare for it to be there. But if somebody thinks it's gonna be a problem, they should kind of look at it, right? So here's like a really simple example we give people when we're talking about how all assets are not treated the same. Right. This is where things need to be you need to really kind of pay attention to. So this example, we got June and Dan, and they've got a total marital estate that's worth around about 1.1 million. Okay. Right. And the way it's broken up is they've got a house, this cottage, that's worth basically $1 million. Yeah. They've got a 401k that's worth 100,000, and then they've got some CDs that are worth 550,000. Okay. Right? Okay. So Dan says to June, hey, I know you want the home. I don't really care. So you can have the home. Let's split the 401k, and then I'll take the cash from the CDs, and then I'll use that so I can go buy my own home or whatever, right? And she decides that that's a good deal, so they split everything. It's 50-50. It's 550 here, 550 here, right? Right. And so she's thinking, okay, I got my retirement, I got my house, and then he's got cash, right? Right. Well, the reality that we look at here is that, he did not tell her anything about what he purchased the home for, right? So when we transfer property from one person to another, so here's the example, right? So if I was to transfer property to you, right, because we're not married, that would constitute a sale, right? And so if I sold it to you, your basis, your purchase price would be what you bought it for, right? But in a marriage or in a divorce, there's no sale here, right? We're just transferring property. And so the basis, the purchase price is going to be what we bought it for back whenever we bought it, right? And so there's no step up in basis. There's no change there. And so people miss that sometimes. And so in this example here, we've got a basis of $150,000. Right. So she decides, hey, I got the house, but you know what? I don't want it. So I'm going to go ahead and just sell it. So she sells the house for $600,000. She's got $450,000 of capital gains. Right. She applies her $250,000 exclusion. She ends up having $200,000 of income that's going to be taxed at long-term capital gains rates, right? So here in Utah, basically, she's going to end up paying $40,000 in taxes. So she ends up netting $460,000, right? We have to remember, how much did Dan get?
550.
He got 550, and the question is, what's basis of cash?
Right.
Typically is what it is, right?
Right.
So she's 460, he's 550, right? And then on top of that, the basis of the 401k is zero. So if she tried to touch that as well, she'll have even less money.
Right.
So this is one of those things we'll look at. We'll say, okay, is it 50-50 on paper? Okay. But is it also 50-50 from an after-tax perspective? Right. And if it's not, then we need to look at it and say, okay, how can we get it really close? Look at those numbers, right? So when we look at total assets, he's at 550, she's 510, right? So those are the kind of the issues we'll look at. Here's another example. We've got some stock, right? Same kind of thing. We're looking at Jane. She ends up getting stock. Frank gets cash. She nets 85,000. He gets 100, right?
Oh, wow.
And so it's really kind of dependent on how people look at this and how they carve it up. So sometimes people say, okay, well, it's a stock account. I'm going to take the stock because it could be valued a lot more. If it was like Tesla, right? Yeah, probably would have been a good choice, right, compared to cash, especially if you bought it last year or 5 years ago. But if it was like ExxonMobil, it's probably not. It just kind of depends.
Yeah, I mean, one of the ways that we did it is I ended up getting the house, and we had put in cash for a deposit, and he had the retirement. So we did a disproportionate distribution of the retirement. So I got a little bit less of the retirement, but I didn't have to pay him out for money that we put in the house. And then we had that he wasn't entitled to any of the equity or anything from the house. So we kind of tried to balance it that way.
Right. Yeah, and so having stuff like that is like super helpful, because then we can kind of look at that and say, okay, is that going to be equitable? Is it going to be even, right? And like again, the way we look at
where it is, like my house is now tripled in value since we bought it.
Yeah, no, it's good. So retirement accounts. So we basically break it into two. We look at defined contribution plans and defined benefit plans. So these are contribution plans have cash value. So these are your 401ks, 403bs, 457s, those types of things, right? And I need to update this report here a little bit, but there's a rule here as an alternate payee in a quadro, you're entitled to, you can actually take a distribution from that plan without any of the IRS penalties. And it's an alternate payee rule, IRS Rule 72T. And I wrote in here, it's a one-time opportunity. It's actually not one time. The plan may have some rules there, but the IRS allows for as many distributions as you want, as long as the money stays in that 401k type plan, right? This is only applicable to 401ks, employer-based plans. It's not IRAs. Okay, it's a little bit different. And so we get into cases where like we'll have a client that needs money for a variety of reasons, right? So maybe they only have money in a 401k plan, and she's got money that she needs to use to pay off her attorney or to go to school or pay off other debts or whatever. And so in this kind of situation, we've got $150,000 from a 401k plan. She says, hey, I need 80 grand. And so she can take a cash withdrawal of $80,000 and avoid the 10% penalty.
Well, that's nice.
That's assuming she's under 59 and a half. If she's over that age, we don't need to worry about it. Where we get into problem is that, again, this is where financial planners, you have to be kind of careful with the advice that you're receiving.
Right.
So there's a guy that I like to read a lot. His name's Tim Shiner, and he says, watch out for the vice and advice. And sometimes financial planners, they look at these quadros and they say, hey, I can step in and I can actually manage those assets, right? And I can help my client, but I'm going to make money, right?
Right.
And so sometimes people will get bad advice in terms of, they'll say, hey, you know what? You're going to get this quadro. So let's say it's a big amount, like $500,000 or something. And we're going to take that, we'll manage that for you. So we're going to move it from that 401k plan and put it into a traditional IRA so I can now manage it for you, right? But what you have to remember is the second that happens, that 10% penalty waiver rule disappears. And most financial planners do not know that. And so I've seen it happen where somebody, we got like a stay-at-home mom or something like that, where they desperately need that money for various things, even though it's retirement money, it's earmarked for retirement, they're going to need to use it because it might be the only source of income they have. And then they get bad advice. They move it they move it from the 401k plan into this IRA, and then they take the distribution. They'll get taxed on it, of course, but they're also get that 10% penalty.
That happened to me.
Yeah.
And just you're like poster child for all the things that could have gone wrong.
So going back to what I said earlier, how I said like dealing with a lot of money and divorce is almost like dealing with a death, right?
Yeah.
If we have a client that passes away and their spouse is left holding the bag with a lot of money, and especially if it was not anticipated,
right?
And they say, Joe, what should I do with my money? And I'll say, we weren't planning on this. You don't know where you want. You don't know where you're going to be, right? You're not in a good position to make a really good long-term, financial decision right now, right? So I'm going to tell you to leave that money alone. Do not touch it. Just leave it there until we know what you need.
Right.
And if we need anything, let's start really basic. What do you need for the next month? Do you need any money for the next month? What do you need? We'll just start really basic. We're not going to be making long-term choices here. Really basic. And then we'll reassess in 3 months. We'll reassess again in 3 months. We'll reassess 3 months after that. And maybe at that point, we'll be able to come back and look at it. And so if we're talking about a divorce client, we'll come back at it like a year later and say, okay, where are you at now? And she'll say, oh, I'm working full time. My debt's under control. This is going well. I'm good here. Do we still need that 401k money? And if they say no, then we'll say, okay, do you want professional asset management? Do you want to move it somewhere? And they'll say, yeah, I do. And then they'll decide, or they'll just say, I want to leave it there, right? Or they may have actually used it. We don't know. But the bottom line is we always tell people, just leave it alone until you know what you need or what you're going to do, right?
For sure.
Anybody tells you to come in and move it immediately, and it could be the right choice, but unless we've really planned for it, it's hard to say if it is or it isn't.
I get that.
Pension plans. So this is where instead of getting cash values, just like those guaranteed incomes. So people that work for the state, people work for IHC. Up here, we got people for Hill Air Force Base and Northrop Grumman. A variety of other auto leave, variety of employers up here in Weaver County. They all provide guaranteed income for life through these pension plans. There's no access to cash there, but these are all divisible under quadros as well too, right? And so when we see a division on the quadro where an alternate payee can get the money now, this is money that you're not going to get until you reach retirement age, right? So quadro, we always talk about that, domestic relations order. Right. So it's again, these are risk governed plans, 401ks, 450Bs, 457s, pension plans, those types of things. IRAs, Roth IRAs are not divisible under quadros. Right. And that's actually a good thing because they're a heck of a lot easier to deal with. Social Security, this is a statutory thing. We always say, if somebody's been married for more than 10 years, they're entitled to half their spouse's benefit. You don't need to have this in a decree. Nobody needs to talk about it. I testified in trial back in February last year and this came up. Opposing counsel was taking issue with it, and it kind of boggled my mind because it's a moot point. It doesn't matter. It's not going to impact the ex-spouse. It doesn't matter. It just is what it is, right? So it's kind of how that's structured. So here's that example. Mr. Smith's going to get $1,000 a month. Mrs. Smith, she could get $500 a month or her own benefit, whichever's higher, right? And so in this case, if she's getting $700, she obviously would take the $700, right? So pretty big. And so kind of like the end thing here is like, when we're talking about people going through this process and we go through it, right? We always talking about what's that financial reality, right? What can you do, what you can't do, what are your options? And we're going to go through all that with everybody and just kind of, help them make sure that they're making that really good, equitable decision. And if it looks all messed up, we'll testify all day long and, fight for our clients to make sure it's, it's not, right? So, the rest of this, I'm not going to go through the rest of this. It's just because it's kind of long, but it's like a case study. But if you wanted to sit down, we can kind of go through that and do all that. But it's there's just kind of that whole thing there. So
this was awesome.
But yeah, let me do this here really quick. I'm going to share. Let me share my screen again really quick, and just kind of show you a few of those resources that I was talking about.
Sure.
Move this over here. Okay, so this, let's see here. You see it? Oh, there it is. So this program right here, it's called Family Law Software. Now it is for professional use, right? But we can give anybody who reaches out to me, they bounce me an email. They're like, "Hey Joe, can I get access to this?" I'll bounce them an email,
Right.
and then we'll just create a real simple login, and then that person can get in there and they can create financial declarations. They can create reports as far as assets are concerned and different things. Let me kind of show you what these look like. I'll give you just a sample example.
Can you add your email in the comments so that it will be tagged with this video, so that if people want to send you an email, you can
yes. Let me see if I can figure out how to do it.
Or I can do it. What was your email?
Oh yeah, it's just it's info, info.
Yep.
At fitdivorce.com.
There we go. It's slowly adding. There we go. So that way they can send you an email, and that email will be tagged to this video.
Right. So let's see here. Okay. So here's like a very basic sample case file.
Uh-huh.
All right, is that catching up? So this is kind of the reports that we would run for somebody.
Uh-huh.
So we can go through and get that breakdown as far as like what real estate equity looks like, cash accounts, businesses, just really segment everything out.
That's awesome.
And show what those, if that particular property looks equitable or not, and if there's an equalization, what it would take to kind of get there. We look at that again on an after-tax basis. This was a report done for Arizona, so it's community property, and Utah's not a community property state. And we look at that projected income, based on what that stipulation looks like, and we can say basically, is this going to be something that's equitable? And this is the biggest thing we'll kind of look, is that projected net worth, right? So quite often we'll see cases where we have two spouses where one's making more money than the other, and the thing I always tell people is like, whenever we take one house and if we take a household and we split it in half, it's going to hurt. What we want to see is if we've got, person A who's making this much money, it's kind of climbing, we want to see the ex-spouse kind of moving in parallel. We don't want to see that, one person going bankrupt while the other person is just killing it.
Right.
Because at the end of the day, especially if there's children involved, if my ex-spouse was suffering financially, ultimately my children are going to suffer, and that doesn't serve them. And that's a huge issue for me as a professional. And so we want to see both parties moving in a good, equitable position if we can.
Right.
And ultimately what somebody does with their money is up to them. So if they blow it and they can't manage it themselves, that's obviously a different problem.
Right.
But that's kind of what we look at. And we run these budget reports. And so we can look at that and say, okay, if there's, I think on this report here, it does show it. Yeah, this one doesn't show it, but, oh no, it did. So like in this case, there's support payments here, right? These are kind of big numbers, I know, but if there's support payments going out, what we want to look at is, at the end of the day, if the budget numbers are correct, right?
They should be almost similar.
Well, it's what we're looking at is we're going to look at it and say, okay, yeah, they should be somewhat similar as far as being able to maintain that lifestyle standard, right? But the other thing is we don't want to see either party in the red down here.
Right.
Right. We want to look at it and say, okay, does he have money left over? Does she have money left over? And if they can maintain their lifestyle standards and they both have money left over, again, it's gonna hurt them both financially to kind of split that household, but they're both going to be okay. And that's kind of what we want to see, right? So that's what that report runs. And so that's kind of how that's structured. And again, we use this program here, this family law software, to do that. And then again, the other thing, that other resource that we use, this is the exchange, that's not what I want, is just that Utah Courts website. We get a lot of people calling us for because they think we're attorneys.
Right.
And they're going to say, hey, they want legal help and that type of thing. And so we refer them to the attorneys that we work with. But there's just so much stuff in here that's just some really good self-help resources. And this, like the OCAP I mentioned already, it's been a while since I've kind of dug through here, but that roadmap that I showed you, that is available on this website. And then they do have the So there's free legal clinics that are here, right? And then there's also so depending on how much money somebody's making, so if they're really low income, they can get that free legal help. And then there's my mind's gone blank. Do you know what the resource is? It's reduced pay or reduced cost attorney services. I can't remember what it's called.
I don't remember what it's called.
But it's actually crying out loud. It's driving me crazy. Let me see if I can find it here. See if I can find it here really quick. It'll come to me probably after we talk, but there's
where's the salt?
There's a space. Oh, modest means referral program. That's what it is, right? So the modest means referral program, this is actually pretty good. So this is through the Utah State Bar. And an individual in this case, so if they're looking for family law help, right? And let's say we've got a stay-at-home mom and she's pretty low income, and so let's say she's got like 2 kids. So besides herself, there's 2 kids, and maybe she's making, $2,200 a month. So that'd be what, about $28,000 a year, right? And then she's got like $500 in her bank account, and maybe she's renting a home, she has nothing else,
right?
And then let's say she's in Salt Lake County, right? You can come in here and just by putting that information in here, they say, hey, you qualify, you can be referred to a lawyer who charges up to $50 or $75 an hour or a corresponding flat fee.
Nice.
Right. So I hear all the time people are like, I can't afford an attorney, or I'll see people go pro se because they think they can't afford an attorney. Or we just have people that are just kind of like anti-attorney. And while attorneys can get really expensive, I get that.
Well, I think it's important because they can protect your interests, especially when you're not thinking clearly because you're overwhelmed in this emotional thing. You know?
Right. And some I've been interviewed before, and people have asked me. I've had other professionals that are not attorneys ask me. They say, "Hey, Joe, what do you think about attorneys?" And I tell them every time I say the same thing. I'm like, I love the attorneys I work with, and and you said this. You don't know what you don't know.
Right.
And I can tell you, I'm not an attorney, but I have an attorney myself for different things, but not for family law. But I would always tell somebody to get an attorney. And even if you're pro se, you're trying to mediate on your own and you're going to fill out the paperwork through OCAP. Again, this case that I just mentioned, where their mediation was 17 minutes long. The mediator was an attorney, but again, the mediator could actually, in order for the mediator to do what they did, they could only represent one party. Right. And so when we spoke to them both, we told the party who was the respondent that even though they agree with everything that's in that document, they should probably go get an attorney and have them review it just to make sure that they're being protected.
You're signing stuff that affects the rest of your life and your children's life.
Right. So, so there's just so many resources that are out there. And I think that's what I love about the Divorcee Cafe. It's just like a really good free resource. And you guys have, again, I just focus on tax and finances, and then you kind of take care of everything else, which is really good.
We're trying, we're trying to reorganize for pandemic, kind of like we kind of died. Do you know what I mean? To be honest, I tried doing Zooms for the first Wednesday of the month and thinking that would help for people to step in. And it was harder for people to step in even during Zooms, and then we're just sitting here for 8 hours going, all right, so what do we do? Because even though it was virtual, it was still having a hard time. And I'm like, all right, well, let's try to do these live streams where I can have the facilitators come on and have it broadcast through multiple platforms, and then also have a YouTube channel where I can have these videos where people can access them later on. At least it's a way to keep the information out there and get the information to the people, because I still want the people to be able to have access to this stuff,
Right.
So we're just shifting and focusing, and I'm still looking for, a permanent location. Before pandemic, it was out of my home. We're still moving forward. We just have to kind of tweak things a little bit.
And you're established as a nonprofit now.
I am. I'm a nonprofit. I haven't had the time to kind of really look into grants and do all that other stuff. That's kind of on my agenda for the upcoming, weeks and stuff like that. It's just really just trying to go, okay, I need to figure out how are we going to frame this? How are we going to reframe and refocus, and then kind of educate people on who we are still and what we're doing, so people know that they can, still get, the support and the help that they need in all areas, the mind, body, and the spirit. Because if you don't heal all of that, then you're just going to get stuck again and just repeat,
Yep.
So.
No, that's good. That's good. Yeah.
This was awesome. I look forward to more in-depth little conversations over the next weeks and months. This will be fun.
Yeah. So we're
finances in order.
Yeah, we're kind of getting into our crazy bit of the year, because we're still doing all the divorce work, of course, but we go into tax season here, and I just kind of like put my head down and kind of go away for a little bit.
That's totally fine.
and then we come back. But when we come back, one thing we did last year, and I think you and I should probably coordinate this a little bit better, but we were just doing like a monthly workshop where I just go over what I go over, and we set it up as a Zoom, and I had that set up through the meetup group.
Right.
And every single month we'd get, some months we'd only have like 1 or 2 people show up. Other months we'd have like 5 or 10 or 15. Awesome. And we just kind of go through that presentation, but we'll have that set up to go once a month and just go through the same things. And I think, just the more information that's out there, the better.
It's important. People need the information. They need to know, because it's not something that people think of when they go through divorce, to go and get someone to go over their finances. Like, it just doesn't, people don't think about that, as far as even the other stuff that you probably should have as far as a team to kind of go through a divorce. It's like lawyer, sign papers, be done. And that's kind of not the whole deal, what I mean?
And I'll tell you, I think, and again, like on our end too, sometimes people say, well, should I hire a CDFA or should I not? And while I agree with you, it's good that everybody looks at those finances. The tough thing is that, unfortunately, it's not necessarily for every situation, right? And it really does boil down to cost. And so we'll work with people, and my partner Aaron and I, we've been talking about it. And so I think one thing that we're going to do this year is, a lot of attorneys, they do basically some of their free legal help once a month. And so that's how you can get that free legal help, and that's kind of what we're going to do is, once a month, we're going to just basically say, we'll put ourselves out there for, 3 to 5 hours for people that need like really detailed help. And we can go through and put that together. So that those that need the help, that can't afford it, we can do that for them, and just kind of give back to the community that way a little bit. And we'd love to do that through Divorcee Cafe. I think it'd be a great way to do that.
Yeah, just let me know, or set it up on the back end with an event or something like that with the Zoom link if you're doing it through Zoom.
Yep.
Who knows when this world is going to open up again?
Yeah. Zoom works, right? It's all right. So, and I think it depends on what county you're in. I was up in Box Elder last weekend, and like they're just operating like there's nothing wrong up there. Everything's the same. So, you go down to Salt Lake, it's all shut down. So it's just kind of funny. Yeah. So I don't know.
Well, thank you so much. And I think we have another one scheduled for next Thursday too, with your.
Oh yeah. I've got lots more content.
I'm going to take advantage of your time before it's tax season, and you have to deal with everybody doing their stimulus checks and stuff like that, and how that.
Let's talk about that next week, because that's a huge mess on the divorce side.
It is a huge mess.
I'm not very political, but President Biden, he says, "Oh, we're going to do more stimulus money," and I just kind of want to shake him. Like, it doesn't work for divorced people.
Well, just for my own thing, like the first stimulus check, I got money for me and my daughter, right? Because they went off for 2018 taxes, and I get to claim my daughter on the even year, right? Because that's how it is. So I got my stimulus check last week, and I'm like, "Oh, awesome! I'll get my stimulus check. I'll get another round," and it was only for me. And I'm like, well, why? And it's because they went on 2019. So my ex-husband got the child.
And that actually works for you, right? So we can talk about it more, but we've got cases where ex-spouses are hanging on to that money. They're not giving it up. And they're getting all of it.
Oh God.
And so it's just a mess.
It is a mess.
Yeah.
It is a mess. Until next week. To be continued.
Okay. Thanks, Ayla.
Thank you. Take care.
You too.
Bye.